Good evening, ladies and gentlemen, and welcome to our class on understanding technical analysis and price action patterns and interpretations. Tonight's class is sponsored by a very unique trading platform known as TradeTime, where they'll allow you to, before you open an account, define your objectives, customize your account and your dashboard, and then allow you to trade in the world's largest markets. It's all about allowing you to build an account that fits your trading style. And if you want to hold on, I'm going to bring up a video they have and let you watch it for a minute while we learn all about TradeTime. And then we're going to go into our class. And then we're going to start our class on price action. And so TradeTime has many different types of accounts for you. You can choose what's most fitting yours, or you can pick up one simple, advanced, complicated. Simply select the account and customize it to your trading needs before you've actually made any deposits. And then you can define your objectives, decide how much you want to deposit, and then take part in the biggest markets around the world. But you can decide ahead of time whether you want to trade stocks, indices, or commodities. And then your account is all developed just for you and just in your name. And you can decide everything about your personality, who you are, what you want to trade, so that all of the emails, all the messages, all the support, all the education is designed just for what you're looking for, so that you can trade in an area and an arena that's comfortable for you. And that's what makes TradeTime very unique. It's all about personalization and customization so that you get the best trading experience possible. Now, tonight, we're going to be discussing how the markets react and how price action is important on charts. And price action is all that counts. Is actually, no matter what kind of technical analysis you're using, no matter what kind of fundamental analysis you're using, no matter how you're making your trading decisions, it ultimately comes down to price and the movement of price on your charts. And if you're not exactly sure yet how to use charts, you should come to our class on understanding charts. If you're not exactly sure how to build a trend line, how to use support and resistance, what technical analysis is, you should come to our individual classes on all of those subjects. Now tonight we're going to be looking at patterns that develop on charts that try to tell us what price, or try to interpret what price is telling us. Now tonight's class is being recorded, and in about 24 hours you can access the recording by one or two ways. You can go to www.investing.com. You know where it is. You've been there before. That's where you signed up for tonight's class. And go up to the Education tab and then locate On-Demand Webinars, and you can see all of our classes. Or if you want to get quickly just to tonight's class, just follow the link you used to come to tonight's webinar. In about 24 hours, and you'll be able to see a recorded version of tonight's class. Now, technical analysis refers to the study of the financial markets based on price movement. Now, a lot of people get this complicated or to misunderstand it. They think technical analysis is all about these technical indicators, RSI and stochastics, MACD and Bollinger Bands. Some of them think it's all about Japanese candlesticks. The fact is, anything that's done with a chart or on a chart is in the field of technical analysis. And ultimately, reading a chart is much more important than all of these indicators and oscillators. Because the first step in deciding what you think an asset is doing comes from the charts themselves and the price movement on charts. Indicators and oscillators are secondary decision-making features. They should not be your primary decision. So you don't want to just pull up RSI and say, RSI is above 70, so I'm going to do this. No. If RSI is above 70 telling you an asset's overbought, It's confirming what you've seen in price action. So technical analysis follows the assumption that the price of a share or an asset reflects all the information about that share, including market sentiment as well as its perceived value. Charting refers to technical analysis that is performed through careful inspection of an asset's price data for identification of well-known patterns that emerge. For example, head and shoulders, channels, triangles, wedges. You'll hear all these terms, but you should know how to see them on charts, because this is what is explaining how price is moving. And it's using actual price in real time. So chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of future trends of an asset as price breaks key psychological barriers in the form of support and resistance. There are numerous types of patterns, all named according to the shapes that the price graphs form between the support and resistance lines. The general types of patterns include triangles, channels, wedges, and head and shoulders. Some people call these flags and pennants. There's all kinds of names. There's often names like teacups, all kinds of crazy things that people see in it. But triangles, channels, wedges, and head and shoulders are the most important. A triangle comes in 3 different types of triangles, actually. We have symmetrical triangles, ascending triangles, and descending triangles. It all is based on the slope of the support and resistance lines above and below the current price movement. So a triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking or more uncertainty about the value of a share or an asset. While a positive sloping support line, the price levels are squeezed into a corner. So what do you have? You have a symmetrical triangle, you have an upsloping support line and a downsloping resistance line. In an ascending triangle, you have a steady resistance line and an upsloping support line. In a descending triangle, you have a horizontal resistance line and a downward support line, because this is actually the reverse of this. But this occurs in an up-moving market, and this occurs in a down-moving market. Although, in rare occasions, you can find them in the opposite markets. Now, with a positive sloping support line, okay, once the support or resistance line is broken, pressure that is built up as a result of uncertainty is released, and a certain amount of momentum is added to the price change in the direction of the breakout. So what we're saying is that as price moves into this triangle and into the center of the triangle, that the buyers and sellers are being undecided. That's why you're seeing little movement in price. And there's a pent-up demand. We don't know whether it's going to break out or break down, because price could break up or break down. But when we get the breakout, there is a calculation we can use to measure the momentum behind that breakout to give us a target point of where that price should move to. So when you have a breakout in price, you usually have an immediate action, and you want to be able to trade that asset exactly when, or in a relatively short period of a breakout, not down the road. You're not going to look for a triangle that occurred yesterday. You're going to be seeing the triangle form, and you'll be waiting for the breakout, whether it's up or down, and then you'll be trading that break. So remember, we have ascending and descending triangles. Oops. Hold on, I'm just trying to get my markers off here. So we have ascending and descending triangles. Now, it's easy when I show you a picture to show them to you. It's very easy to see them clearly. It's harder to spot them on charts because a lot of times you don't have an exact horizontal or vertical line. Now, you get these by connecting the swing highs to other swing highs and swing lows to other swing lows. They look like trend lines, but they're not because there aren't rules about them. They are, if you notice, let me get my marker on here again for you. What we're doing is we're drawing a line connecting the swing lows. And that's all we're doing. You're drawing a line under the price movement, and we're drawing a line over the price movement. And what does it form? It forms your support and your resistance levels around the price. But and you notice here we have a triangle, okay, and it forms a triangle. It's just a standard symmetrical triangle. The lines aren't exactly perfect, but they're perfect. So down here where we have the ascending triangle, you have to be able to visually see it. But as you can see, it is ascending. Price is moving up. The bottom support level is moving faster than the upper resistance level, but the resistance level here is not exactly horizontal. It doesn't have to be. Now here with the descending triangle, we have a very picture perfect triangle, but it doesn't have to be so perfect. What we can visualize is prices moving into a corner, forming this triangle. But the edges of the triangle are not textbook. They're not drawn with a straight edge or with a ruler. So when we see these, and they're quite common. So you ask me, how do you see these on a chart? Let me bring up, I have some live charts. Let me pop up a live chart on our screen, and we'll see if we can see a triangle forming or a triangle in the chart. So hold on one second. Okay, so here we have, hold on one second here. Sorry about that. There we go. Here we have Ethereum. What asset we're looking at is unimportant. But look what we have. We have this beautiful formation of a triangle at the current market level. Now, we call it a triangle. Some people call this a pennant. Okay, I don't use the word pennants and flags. Triangles are just easier to say, and so we stick with triangles. But we can see the upward slope and the downward slope of the support and resistance line. And we see prices moved in to the center of, or the point of this triangle, right here. And we can have, we're hoping for a break upward, but we could have a break downward. We don't know. Right now, we don't have any indicators supporting a decision. We see that both our RSI and our RSI is in the middle of nowhere. We don't see any crossovers with MACD, okay, and we don't see any convergence, okay, and we don't see any other clues. So we're waiting for something to happen. We're going to wait for a breakout. The breakout could be up or it could be down. And this is a live up to the minute chart. So this is how, I mean, sometimes they form as beautiful as you see them here. Not all the time, but sometimes they're absolutely beautiful. But you have to be able to spot it. Then we have, on gold, okay, we have another formation going on here. And again, we have a new triangle developing. We have our support line that would be drawn here. We have our resistance line drawn here. It gives us a perfect triangle. And we had price coming into this point, but look what happened. It broke out. And what did it do? It broke out upward. Now, once we have the breakout, there are formulas that we can use to determine how much momentum and how far we can predict this breakout will be, so we can decide where to enter the market, where to put our stop loss, and where we could project our target level would be. So let's go back to my PowerPoint and let's talk about how we would do these. So give me a second, let me get the PowerPoint back up here. So it's important to note that an ascending triangle can also be found in a downtrend. Okay, sometimes you can have the reverse occur. It's very rare, but they can be. So the combination of the name of the triangle and the market trend can be deceiving. Thus, the financial asset needs to test the resistance level twice, and the asset closing price needs to be higher than the previous closing price. In other words, the closing price has to follow the rising trend line. Now, one of the key clues that we want to look at when we're seeing a triangle is volume. Because as we move into the center of this triangle, the point of the triangle, where we're moving into pent-up demand, volume should be either relatively steady or declining, because the traders haven't made a decision. The minute it breaks out, we should see an increase in volume, because now the traders have finally committed to something. And this when they commit and break out upward or downward, that volume should increase as more and more buyers or sellers then enter the market. So we need to, when we come to volume, when it's an ascending triangle, volume usually contracts as it's coming into the center of the triangle. Although there are a few cases that show volume has not contracted, but the pattern has been displayed. When volume hasn't contracted, like I said, volume should be either steady or declining. Because a lot of times volume has already fallen off as we've moved into the triangle, and so it's already low when we get to the central point of the triangle. Now, we can use the distance, or the rule of thumb is the distance between, from the start of the triangle, from the support and resistance line, the distance that the asset moved, which would be, no matter what the asset would be, the difference of the price at this point to the difference of the price at that point, should equal the climb of the price when it breaks out. So the distance between the rising trend line and the resistance level will give us our projection. So if a resistance level had a value of 1, and the start of our trend line had a value of 0.5, then our projected value would be 1.5. So that would be our new value, which would be the equidistance of that move, or how much that asset gained. And I'll show you this in a more concise manner in a second. But this gives us a way to judge how far we expect, or what the momentum is in that action or that price movement. Because what we want to do is we want to look at the price action, and we want to be able to determine how we can trade that price action. Now, triangles are very, very common. They happen quite often. We also have rectangles and channels, and they're relatively the same. We have a support line and a resistance line. A channel is running on an angle up or down depending on whether the trend line is moving up, and a rectangle is actually a combination of double bottoms and double tops, or triple bottoms and triple tops. So it's actually price moving just between the support and resistance. So similar to a channel, a rectangle is a pattern formed between horizontal support and horizontal resistance. So a channel has either upward or downward resistance and support, and a channel has sideways. Now, rectangles and channels are sometimes referred to as flags and pennants, depending on the slope of the initial trend. A flag would be defined as a bullish continuation channel down or a bearish continuation channel up. So basically you have a channel. It's moving up or it's moving down. So you can call it a flag or pennant. I don't use flag or pennant. I just use channel. And I don't even call them channels, wedges. You know, they're all patterns. As long as you can recognize a pattern, you don't have to give it a name. Then we have wedges. Wedges are very similar to channels, except they're moving together. Channels move in unison in the same direction, where wedges are still forming into, they just haven't made into a triangle yet. So they're very similar triangles, and I don't separate them from triangles. It's just where the breakout occurs. Wedges are similar to triangles, and these patterns are formed between converging support and resistance lines. However, where the support and resistance lines in a triangle have one positive and one negative slope, the support and resistance lines of a wedge would both have either a positive or negative slope. Wedges with positive slopes are called rising wedges, and ones with negative slopes are called falling wedges. That's not so hard, is it? Positive slope, negative slope. Visually, you can see it. One's climbing, one's falling. Okay. Rising and falling wedges. Now, the most common wedges are found as breakouts in the opposite direction of the wedge. That is, bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. A wedge usually tells you that the trend action that's taking place is ending and will break in the opposite direction of the wedge. So in other words, here we have this wedge. When, in most cases, price will break out this direction, the opposite direction. There's no law that it can't break out that direction, but in most cases, it's going to break out in the opposite direction of the wedge. So if you have a climbing wedge, price is going to fall. If you have a falling wedge, price is going to climb at the breakout. Then we have the world's most well-known pattern, and that's called head and shoulders, or inverse head and shoulders. Inverse head and shoulders is just the opposite of a head and shoulders. Now, head and shoulders, when they develop, are quite telling patterns. They are defining price action on a chart. When they happen, pay attention to them. And because there are several parts of it to take place, you see them way ahead of time. In fact, you'll see them way ahead of time, but you won't recognize them that they are head and shoulders yet. Because what happens is price will move up and just form a top. Okay? Bounce off the top and come back down. Well, at that point, you don't have much of anything yet except price movement. But then it's going to bounce off of that support line and come higher than the previous top and come back down. Now, some people say that there is a formula between, or what they require the minimum distance for a head to be found. Okay, I don't put any minimum requirement, because if you just imagine head and shoulders are defining two shoulders and a head. Some people have long necks, some people have short necks, some people have fat heads. Okay. But when price falls back down, it should come fairly equal to where the prior decline was, because this forms what we call the neckline. So this point here, let me get my markings off of here. This point here is the basis for our neckline. This is the headline. This is the formation of the left shoulder. But it's hard to see that so early in this stage because it's also just price moving. Okay. But when price declines back down here and stops on an equal level or an equal support level, a resistance level, no, support level, and that support level is exactly where it was before on the left when the shoulder formed, you now start to see that you might have the possibility of a shoulder, a head and shoulders form. So then price will expect to bounce back up, and it should come up to a resistance level which is fairly even with the formation of the left shoulder. Doesn't have to be exactly the same. Because, you know, some people are cockeyed this way. Some people are some people you could be holding your shoulder up. So just imagine the different stances of people. Okay? Because again, we're going to see it develop. Now, what we're going to be looking for is the price to come back down to this neckline. When it does, we are expecting it to break through that neckline and come down into this action. And we can calculate the target price because it is the difference between the head and the neckline. And I'm going to show you these formulas in a second. An inverted head and shoulders is just the opposite. This will actually occur during a head and shoulders actually occurs during an upward rally, and it's telling you that rally is about to be over, where a inverted head and shoulders tells you it's part of a downtrend rally and is about to end. So a head and shoulders pattern describes a price movement that depicts the head and shoulders of a person. The head and shoulders is a reversal pattern from a bullish trend to a bearish trend. The pattern starts from the price graph, crosses the support level upward before the formation of the left shoulder, and is completed once the graph crosses the support line downward after the formation of the right shoulder. So it takes a while to form all of this, and it's not one fell swoop price movement up here. You're going to see that price bounces all up and down. It falls within there, but you have all kinds of activity. It's not up, down, up, down, up, down, okay? Because price just doesn't move that way. You have lots of bars or candlesticks in between. So the popular head and shoulders pattern is essentially a triple top pattern, except that instead of all peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Some investors have specific beliefs about the amount of the bearish fallback that should occur between the tops. Okay. And there's all types of stuff you'll read out there about formulas or how they calculate how high that head should be, or what the difference between the shoulder and the head should be, to verify that it's really a head and shoulders pattern. Regardless of opposing views, these patterns are very popular among traders and analysts as they predict trend reversal with relative reliability. Signal strength is bolstered by agreements from other indicators, such as waning volume as the trend nears its exhaustion. Now, the fact is, it's hard to see these. Because, like I said, you have lots of candles in here. But if you follow the rules, what you see is price moved up above, broke the resistance level, broke up, came up and formed a high. You have all these candles in there, but look at where it formed the high. Okay. So this gives you the swing high of that trading action, whether you're looking at 15-minute candles, 1-minute candles, 1-day candles. It bounced back down to the previous resistance support line, and then bounced back up and broke through the resistance line and came back down to touch the support line. It moved back up ultimately to the resistance line and fell back off that resistance line, moving down. So there's lots of candles in between there, but the pattern still exists and the rules still exist. But this is how a head and shoulders is found. It's not found with that straight line up, down, up, down, up, down. So you have to be able to see this within your chart. And the only way to see these are following the rules by drawing these support and resistance lines on the chart. Now, a head and shoulders indicates both the end of a trend and the possible change of the direction of an asset's price. The given pattern is formed in an uptrend representing 3 peaks of the market price arranged in different levels. 2 lower peaks called shoulders are located at the 2 sides of the highest peak called the head. The pattern's low are connected by support levels called a neckline. The price falls below the neckline or the support line, it gives you a sell signal. So when we have the formation of the right shoulder and it falls below the neckline, it's automatically at that point giving you a sell signal. So it generates signals. Now, you've got the signal, and you want to be able to calculate how far that asset should move. Because, if you're using the proper risk management tools and everything else, you may say, oh, that's not going to be far enough to make enough profit for me. Or where would I exit the market, or where would I put my stop loss? So it's a very simple calculation. So remember, we have the neckline here. We have the headline here. We have a right shoulder, a left shoulder, and a right shoulder. Now, as you can see, the left shoulder and right shoulder are hunched. So this person's got a higher shoulder on the right side and a lower shoulder on the left, but it still followed the rules. Now, to decide where our target price should be when it breaks out, so when it broke down and broke the neckline while it formed the right shoulder, that generated a sell signal. We need to figure out where our target price is, or where we should ride this asset down to. The target price is a simple calculation, which is the neckline minus the head minus the neck. So if we were to say this neckline was 1, the headline was at 2, what would we calculate? The target would be the neckline, which is 1, minus 2 minus 1. So what do we have? The target is 1 minus 1. Because 2 minus 1 is 1. 1 minus 1. So that target would put us at 0. And if we were following this graph correctly and drawing these lines, this would be the 0 line. Happens to be that's what the calculation is. Okay, it's not a 0 line. This is just a mathematical calculation. So if we said this was a 5 and a 10, because we're using the real numbers on charts. I'm just using hypotheticals here, but we would actually be using the price lines or the prices of the actual asset. And we can apply this formula also to an inverse head and shoulder because it's just the reverse. Okay. Now, one of the most popular patterns is formed with multiple tops or multiple bottoms. And what do we get those? We get those mostly off of rectangles. Okay. And the more times that rectangle is formed, the more valid it is. So here we have a simple double top. Double tops occur often. I don't trade them at all. But it means price moved up, hit the resistance level, came back to support level, moved back to the resistance level, and fell back to the support level. Okay. Now, because double tops happen all the time, you can't pay that much attention. Now, there are all kinds of things called channel trading, and you can trade the movement between these channel lines, just up and down, bouncing off the support and resistance. But I put more validity into the triple tops and the triple bottoms. Okay, and that's when it occurs 3 times. Okay, when it occurs 3 times, most likely you are ready for a breakout in the opposite direction. So triple tops and triple bottoms are reversal patterns that touch either the support or resistance line 3 times before reversing their trend. This is a stronger indicator of a trend change than a double top or double bottom. Look for the strong initial trend and a significant breakout in order to confirm the reversal. So a triple top is a price pattern which is formed in an uptrend and is followed by a drop in prices. The pattern comprises of 3 consecutive peaks arranged at the same level and 2 bottoms. So it's almost like a head and shoulders, except the highs are all the same level. So we're not forming a headline and shoulders, we're just forming 3 tops and 2 bottoms. The formation is considered to be completed if the price breaks the pattern's minimum. It can be interpreted as a downward direction of a trend serving as a sell signal. Now, how to calculate is very simple. It's T, is our target price, is equal to the support level minus the height of the resistance level. So if we take the height, that is the distance between the support level and the top, which is the resistance level. So this is the height. We could then expect the decline to the momentum from the decline or the breakout to be equal to that height. Now, it can go farther, but that's the trade allowance, and that's the number you should be using in your risk management tools. That a triple bottom is the exact opposite. It hit the bottom support line 3 times and the resistance line above twice, and it would occur in a downtrend. And it's signaling a reverse into an uptrend and giving you a buy signal when it breaks that resistance line. And to figure out where your target would be, you just use the exact opposite formula. Now, that all sounds pretty easy. Okay. And if life was that easy, we'd all be getting rich trading. But lots of this stuff will occur. You'll get lots of triangles, you get lots of wedges, you get lots of angles, you get lots of double bottoms and double tops. The first thing you have to do is determine the quality of the pattern you're looking at before you can figure out if it's giving you a tradable scenario. And this is by interpreting the strength of the actual trend, the development of the trend. And this is depending on whether you're looking at just trend lines and looking at it, but is actually, has the trend developed properly? Because lots of times you'll get a weak sideways trend or a weak trend that's all erratic. Even though it forms the pattern, it won't have the momentum to carry it during a breakout. Where when you have a strong pattern, it's important. And a strong pattern, just like whenever you see a rally or an uptrend or downtrend, you should see a push and an ease, a push and an ease, a push and an ease, and you should be able to judge the angle in which that trade is going and how well developed it is. Because a lot of times you'll get the push and the ease, 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 and you're making not many headways. So there are rules about this, okay? And understanding trends and how valid that trend is and how strong that trend is, because each time it pushes upward, the ease should be always higher than the prior ease, okay? And the better and more well-defined that trend is, the more you could rely on that pattern that when you see it develop. So now the pattern is said to have broken out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it's called a continuation pattern. Because if you're moving in a uptrend and price breaks out of that channel or that triangle and breaks into the direction of the trend, what is it? It's a continuation, because now you're telling the momentum has regained that upward, the movement of the trend, and will continue that trend on. If it breaks out in the opposite direction, it's a reversal pattern, which is telling you that trend is not going to continue on and the markets are reversing itself. So understanding trends and breakouts, and whether they're continuations or reversals, and also how strong the breakout is. And that, again, remember we talked about volume. You want to see where the volume was pushing it to. But these give you simple ways to trade. Okay. You can get this form that you're seeing, this diagram you're seeing. Just go online and do just do a search under Google for chart patterns, and you'll find the same thing. That's where I got this. But these are the standard formulas of how you would measure and where you put your stop loss and your entry point for each one of these patterns. And you would always calculate it very easily it gives you your stop loss, your entry level, and your target point. Okay. And it will get you to where you're going. Okay. Now, I'm going to take you over to some other information. You say, okay, that's a lot of work. That's difficult. Where am I going to find these? How many assets am I looking at to figure these out? You know, do I have the time to spend on this? So if we come over here, there are some easy ways that we can help you with that. Investingcom has developed a very easy way to help you. if you go under technical analysis and you go under chart patterns, they will give you a list of all the assets that are developing at present into patterns. So we can see the Hong Kong dollar, Japanese yen in a 15-minute trading interval at 9:15, and that's when I brought this up last, was, let's see if we can refresh it. Okay, so we see that gold versus the pound at 9:30 this evening in a 30-minute chart was forming a triangle, which is a continuation pattern. It's over a period of 95 bars, so that's, and it tells us the quality of that formation. You can see up here the Hong Kong Japanese yen, we on a 15-minute chart started at 9:15 this evening. It formed a triangle. It's a continuation pattern which has covered 136 bars and is rated at 0.74 quality signal. These are completed patterns. This is showing when the patterns are over. We can see emerging patterns below that, and I pay more attention to emerging patterns because I'm not going to trade something that's already formed the pattern. I want to see it developing. So down here under emerging, we can see the Swiss franc Japanese yen in a 15-minute chart started at 9:30, giving us a flag, okay, which is a triangle. It's a continuation pattern. It's lasted over the last, it started to develop over the last 24 bars. It's still in development, and it's a very high quality signal. Okay. So we want to go over to that asset and start drawing it on the chart and watch it move in and start making our trading decisions. We're not ready to trade yet. We're going to watch for that pattern to completely develop. So it was earlier, and we'd be looking for that pattern to break out upwards. So a little bit earlier, it was moving into a inverse head and shoulders, but didn't form the complete shoulders and has moved to a continuation pattern or a flag. Okay. We can see that gold, euro is in a rising wedge, and that's a continuation pattern. We're expecting it to break out and continue the current trend, and we see how those trends are evaluated. So this gives you not a trading decision. It's forming you or telling you which assets and which are forming these particular patterns. And you can set all this up under the technical analysis part of Investing.com. And then you can just go over, once you see them developing, go then spend your time drawing them on your charts. Or if you're, if you're following a particular asset, you'll see that developing on the chart in the current real world, and you'll be able to draw that on and watch it move forward. We can see that on the Ethereum chart, it's a 4-hour chart, so we only get a bar every 4 hours, but the most recent bar is still in there, or the most recent candlestick, but now that candlestick is a doji, which is giving us some forewarning also right here, but we're waiting for it to move a little bit closer. MACD, since we started this class, we can see the signal line and the MACD line are moving a lot closer than we were about here. They're moving a lot closer to convergence, and we see that RSI still is not in an overbought or oversold situation. So we're still waiting for the markets to make a decision on Ethereum. And if we look at the earlier gold chart, we can see that continued breakout, and we're expecting it to still continue up, because if you would have used our formula, your momentum breakout should be the same equidistance as the backside of this triangle. So we've got the breakout, so we're expecting it to come to this level. And this is where we're moving. So I hope we pointed out some things of interest to you. I hope you understand how it's important to be able to see price and price action on the charts, and how you can determine what you're looking at on those charts to turn into some type of understanding or predictive quality, so that you can start making some decisions ahead of time and prepare for where the assets are going. And then all of this can be supported by adding on your other technical indicators below your chart. Because remember, your technical indicators, like we saw on the Ethereum chart, are your secondary line of defense. This is your primary, your price action and your chart pattern. Now, we can add volume onto this chart, which of course is very important. So let's add some volume onto the chart. And look, volume is doing exactly what we would expect it to do. Volume has been steadily declining as we've moved into the center of this triangle. So the markets are waiting for a breakout. Look at this drop in volume. And we're going to be sitting back watching that. And remember, volume should dictate how strong that momentum is when we get the breakout up or the breakdown. So on that note, I'll say thank you very much for joining us. Again, go to www.tradetime, start customizing your own account. You can do all this with no deposits, no information. Start customizing it, making it yourself, picking all the answers so that you can develop it just for yourself, and then open a free demo account and see how it is when you have an entire platform that fits your personality. And on that note, thank you very much for joining us, and we'll talk to you again real soon. Bye now.